Hey everybody, part 4 of positioning yourself to thrive in retirement. Now this is the crucial point where we now start talking about how to put together the investment portfolio. The first 3, we're talking about positioning yourself properly. When it comes to retirement's hierarchy of needs, we need to make sure that things like income and budgeting come first. Understanding the flow of your money through that bank account becomes very important for efficiency. So now let's look at efficiently investing your money the way that's right for you, because it's not always the same for everybody. So let's talk about safe investments versus stock market investments. Everybody's going to have a different mix when it comes to this. So let's start by exploring why we're investing. Ask yourself, who are we investing for? Are we investing for yourselves to spend this money, or are we investing to give this money to your heirs? That creates a different situation based on every individual need. If we're frugal and we're not really using our savings and we do want to give it to our heirs, that's going to be a completely different mix of investments in your portfolio than it is for somebody that wants to spend their last dollar on their last day. So next, what makes you feel worse? A lot of people go through a transition in their life. Once they head into retirement, the answer to this question is different. Which makes you feel worse? Move to cash and you miss out on a 20% jump in the market, or stay in and lose 20%. Okay. When you head into retirement and start relying on your money, going through a 20% loss in the market kind of feels a little different than when you're in your working years and you don't need this money and you can't touch this money and it's just turbulence to do it to you. And most people don't even see it because they're not paying attention. So we have to make sure that we start understanding our own feelings with this money. Most people head to retirement and start paying attention for the first time, and it's awakening, that shows that turbulence, and you're paying attention, and it gets a little harder to tolerate it. Plus, we don't have as many years to wait for the market to come back. So everybody's a little different in how they feel about these things. Feelings become very important, especially in retirement. In order for you to enjoy your retirement, we have to explore those feelings. So then that age-old question, do your resources meet your needs, right? If you did the budgeting properly, if you figured out what the I need to pays and the I want to pays are, then you should have an idea of what you need in retirement in terms of monthly income and annual fund money, right? Well, there's an easy way to figure this out. The math is simple, but it's so powerful. It really does help you see this money and show you that path of how to use this money in retirement. Okay? It's very simple. Take all your savings and divide it by how many years you have till 100. Okay? I call that your years in retirement. You can argue and say there's no way I'm living to 100. Great, but we don't want to, use a number that was too short. So you want to make it 90, go for it. But I always typically start as a default with 100 years old. People are living into their 80s regularly. A lot more people are living into their 90s. So we do need to take that into account. I know the average age has actually come back through this pandemic. But we do still have modern medicine extending the life of people all the time. So very simple. My example here, 65 years young, we got 35 years of retirement, divide the $1 million by 35. That comes up with $28,000, which is how much you can withdraw at zero growth. That assumes no growth for a reason. Okay, it's very important that we understand this. There's a reason that there's no growth on there. Okay, so that's our baseline. That's how much we're allowed to withdraw from our portfolio every year with no risk. We have no problem spending our money every year for the rest of our lives and not running out of money if we do this math every year and tell us how much to pull out of there. Now, on top of that 28,000, we have our guaranteed income. Social Security and pension for most of us. And if you have one of those income annuities, you can add that in there as well. So 28,000 plus 40 is 68,000. If your I want to pays plus your I need to pays equals 60,000 in this example, then you have enough in retirement. You have enough resources to meet your retirement needs. Okay, this is really important math that we understand, because now we add growth to this, and you're getting 1 year older every year, and that withdrawal will get bigger every year when you do that calculation. And that's going to help you keep up with inflation. So the idea of investing in retirement is don't lose your money and help you keep up with inflation. That's the idea of this if you're trying to spend your money. That's the key. If you don't need your money, you don't need to do this math. Invest it however you want. Invest it for your heirs. But if we're investing for ourselves and trying to figure out what we can spend, this math really helps people. All right. So now, what if there's a problem with this math, right? What if it was flip-flopped? Well, we need to go into problem-solving mode. It's very simple. Fix the problems when you come upon them. If you don't have enough income to pay your base living expenses, fix that problem. If your resources don't meet your desires in retirement, fix that problem. There's lots of ways you can do this. You can reduce your lifetime expectation. So if I used 100, sure, you can drop it to 90 because you don't think you're going to live to 90. That's perfectly fine. If that fixes the math, then it was close enough anyways. All right. But there's other ways that we can do this. If you have a mortgage, consider paying it off. Consider a reverse mortgage. There's lots of things that you can do to make some adjustments in retirement. But I'm telling you, this is a great stop point. This is something that needs to be fixed. So now let's explore the effect of volatility. All right. So here's that $1 million, and withdrawing $28,000 a year. I started at 65. Money's just sitting in the closet earning nothing. And there you go. That's the balance left in the closet. 28,000 withdrawn every single year. And there you are at 100 years old living on credit cards. All right. Don't worry. At that point, you won't know you're broke anyways. It's fine. So what happens if we do the same thing, but we throw 100% of it in the market? Okay, if you've learned anything in any of my education, turbulence is bad during withdrawal. So let's see what happens. The S&P 500 for the last 20 years or 2 decades, I have repeating here, right? So I have to call it the typical mutual fund portfolio, but just model the S&P 500, you'll see those results on there anyways. So you'll notice the value of the account, it goes up, it goes down, it goes up, it goes down, it goes up, it goes down, it goes up, it goes down. It's a bit of a roller coaster, but hey, we made it. All is well. Got $189,000 left. Technically, this averaged 4%, a little over 4% return. So what if I just decided to put it in a 4% CD? Because you can get those right now. You can get better than 4% these days. Seems over 5%. I got somebody 6%. So the reality is we need to look at, okay, that's all in the market. What happens if we do all out of the market? And I wanted to make it equal, because this is the math that bends people's minds. They don't seem to understand it. And here it is, 4%. Notice the balance just grew and grew and grew and grew and grew and grew. And there you are, 100 years old. You still have $1.8 million. The math is actually very simple. 4% is not the same as 4%. Right? How does that make sense? Scott, that doesn't make sense. Well, here's why. 4% of $1 million is how much money? Right? Okay, that's $40,000. Well, wait a second. We only pulled out $28,000. So that means $12,000 stayed in, right? And then we earned 4% again. So now 4% of $1.011 million, it just grows and grows and grows. The problem with the 4% in the stock market is that's a 4% average without withdrawals. The problem that now incurs is the math changes when we start making withdrawals. Think about it like this. You have 18% gains, and then you go through 9/11 and lose for a few years straight. So imagine earning 4% on 700,000. Well, that's not the same amount of dollars as 4% on $1 million. And so going through that turbulence and pulling money out, when you have those bigger earnings, like 25% after 9/11, you're only earning 25% on $570,000. So that turbulence minus the withdrawals destroys the portfolio, and 4% really doesn't perform like it should. That's why we need these safe investments, because that 60-40 portfolio that all those statisticians that they can prove in court is the best portfolio for people that need their money, astronomically better. This person pulled the same 28,000 out, put the same $1 million in. Instead of losing 24% in 2002, they lost only 4%. Much more stable portfolio. Okay, instead of earning 25%, they earn 17%. They're not earning as much, they're not losing as much. It's just a much calmer portfolio, limiting the exposure of loss. And there they are, 100 years old with $6.7 million. It blows away the other mix, the all in, the all out. We don't have to have it all in or all out, but I will tell you that a good stable portfolio with a plan to never have to pull from losses is always going to win, period. I hope we understand that. So here's the mantra that you have to live by. The higher your dependence on your portfolio for income, the less it should be left to chance. The larger your withdrawal rate, the greater the effect of volatility. Deposit into volatility to build your wealth. That's what most of you did. But then change it and withdraw from stability to keep that wealth. This is such an important transition for people. It doesn't mean everybody has to have safe investments. It means the people that are withdrawing from their portfolio regularly need to have safe investments in that part of their portfolio. That's so important. The other thing we have to do is treat each tax type, each bucket of money, tax type of money, we need to treat it differently because it comes with different rules. This is so important. I'm tired of seeing 3 different accounts, IRA, Roth, and after-tax money, all invested in exactly the same. We can't do that. They have different sets of rules. We need to be more efficient with our situation and invest it properly for each tax class. So, IRA money, everything is taxed as ordinary income. You must withdraw after the day you retire. And here's why. The reality is you got to save this pre-tax money without having to pay taxes on it in your working years when you were making more income and paying higher taxes. You will retire. Vast majority of people have less income in retirement, and at that point, it's time to find every opportunity to take as much money out at lower taxation as possible. We should always be looking at this IRA money and looking at the big picture, the long picture, not only your life, but your heirs' life, looking at this and saying, what is the best way to pull this out at the least amount of taxation? So for most people, you got to withdraw from this money every year after the day you retire. So because of that, stable investing is going to produce better results. We're not going to need to pull huge chunks of money out of IRA because we're just going to fritter away money to taxes. We're going to pull a little bit every year for the rest of your life. And then your kids or your heirs are going to pull a little bit for 10 years and get all the money out at that point. So this is your heirs' least favorite money. They prefer we get it out as much as possible. But I've run into a lot of scenarios where I tell people, don't you pull $1 more than you have to. There's no reason for you to convert to Roth. There's no reason for you to focus on getting money out of your IRA. First reason, not to do Roth conversions, not to pull extra money out of IRA. Well, first of all, you have to not need the money. I guess that would be the first reason. But beyond that, I had a single person with a big mountain of IRA money with 8 kids. And she wanted to give the money to the kids. Well, a big mountain of IRA money split into 8 tiny mountains. By the way, all the 8 kids were married. So a single person paying taxes on a mountain of IRA versus 8 people splitting the money up, paying taxes on married tax brackets. The kids are going to pay way less taxation on that money. And so all of a sudden, the lights went off and said, holy cow, we should be not pulling any extra money out of that IRA as possible. The other one is if you're charitable. You can give to charities from your IRA after 70 and a half, and the withdrawals from IRAs that go directly to charities are taxed at 0%. So would you rather pull the money out aggressively and pay taxes on it, even if it's low taxes, even if it's 12% taxes, or give it to charities that you were going to give money to anyways at 0 taxes? So those are two things that we got to think about when we look at this IRA. But the vast majority of people, you're going to have to withdraw every single year for the rest of your life. Roth, everything's tax-free. We can invest in ways here that we can't and shouldn't invest in other parts of your portfolio. Growth and income with no tax consequences is wonderful, but we do have to understand losses are absolutely the worst thing here. Compared to the other two, losses are way worse in your Roth. Think about it. In an IRA, if you invested $1,000, you lost, you got $100 left. You pull the $100 out, you pay taxes on the $100, right? You didn't have to pay taxes on the $1,000. You got to invest that before you pay taxes on it. And when you pulled it out, you only had to pay taxes on the $100. So you don't have any write-off because you only had to pay taxes on the $100. Well, in Roth, you pay taxes on the $1,000 before you invest it in the Roth. So you pay taxes at $1,000, you lose the money, and now you're pulling out $100, but you paid taxes on $1,000. That doesn't seem fair, okay? On the after-tax non-qualified money, you get to write those losses off on your tax return. Not that losses are good, but at least you get the benefit of writing it off on your tax return. So Roth, bad place to be very aggressive. I have no problem with growth investing in there for long-term growth investing, but the reality is losses are by far worst here. There are alternative investments that are publicly traded, generally accepted investments like REITs, real estate trusts, and MLPs, master limited partnerships, and closed-end funds. These are usually terrible on taxation, but they're great, stable income producers. And so those can be wonderful in Roth as well. And remember, if you care about giving money to your heirs, this is by far their favorite money. All right? Now, all the other money, all the money that's not IRA and not Roth, okay? This is your non-qualified after-tax money. Maybe you call it your trust money. This money, we have to be careful with, okay? Every choice of investment comes with different tax consequences. So whoever's picking the investments in here should understand taxation and be willing to talk about taxation. Investment advisors shouldn't have a problem talking about taxation from 10,000 feet. The nitty-gritty details of filing tax returns you have to leave to CPAs. But the reality is talking about tax planning when it comes to your portfolio and income planning, it all comes together. And every choice we make in this part of our portfolio is going to come with different taxation. So some of the rules you want to try to live by: avoid interest. No more CDs in this part of your portfolio. No corporate bonds in this part of your portfolio. Put them in your IRA. That's where you're going to be withdrawing from. You need the safe, stable investments there. Stop putting them over in the after-tax non-qualified portfolio. Also, avoid those mutual funds. Mutual funds are terrible in this part of your portfolio because of the turnover rate. You can't control the advisor that is managing that portfolio. They create these non-qualified dividends, these short-term capital gains. They cause problems with taxation because they're allowed to buy and sell within the portfolio, even though you didn't buy and sell. And so we get these surprise 1099s that show up and say we have all this taxation and we didn't even sell anything. You can't control your taxation when you do that. So no, none of these mutual funds, especially these high turnover mutual funds, actively managed mutual funds. Get out of that stuff. Nothing actively managed over in this non-qualified after-tax portfolio. And then we also have to remember, in terms of efficiency, if we are giving money to our heirs, whether we want to or not, in this part of the portfolio, stock ownership, ETFs, they all step up in value upon your passing. Okay, so does real estate. If you have investment real estate, if you own stock portfolio, these things all go to your heirs with no taxation. If If you got a whole bunch of gains in there and you haven't paid taxes on them and you or your spouse passes away, boom, they just step up in value, and then the heirs can sell them at no taxation. Huge advantage there. So when we start looking at this chart now, it starts taking on different meaning. We understand that age really doesn't have anything to do with this, right? So we have the allocation to stocks on the vertical here. And each of these lines is those statisticians that have all the proof in the world that this is the best way to invest, and they can defend that in court. We learned that instead of age, it's really based on your need for money. They're assuming that if you're in your 60s and 70s, that you need your money. So that 60-40 portfolio, 60% safe, is ideally the best portfolio when you're consistently withdrawing. For a lot of people, that means we need to treat each part of their portfolio differently. I run into people all the time that they live off their income and then that required distribution or just a regular withdrawal from the IRA. So that means the IRA needs to be invested as if you need that money. You're going to be withdrawing regularly? Great. We need to have more towards that 60-40 portfolio. And then the rest of your money, your Roth, your after-tax money, you could invest 100% in the market. Okay? If you don't need your money, you can defend anything that you want. It's completely up to you and your personal risk tolerance. If you need your money, then you need the safe investments. More money is better, right? We need to be efficient with this part of the portfolio. So this is all going to be based on need and type of withdrawals, the amount of savings. Are you Warren Buffett? You know, at some point, if you're pulling $1 to go to McDonald's and buy your breakfast sandwich, when you're pulling from billions, it doesn't really move the needle. So current market position, certainly risk tolerance, your own personal risk tolerance. Start with the need based on withdrawals and then go to personal risk tolerance. Some people can have all their money in safe investments. Some people can have all their money in the stock market. Some people should have some of their money in safe investments and some in the stock market. Everybody's different and it's okay. There's no right answer for everybody. You want to leave it to your heirs or spend it? Should we be investing for your heirs? Are your heirs 30 years old? We should put it all in the market. Oh, but you can't sleep at night? Then we shouldn't, right? So everybody should have a different portfolio. It should make you feel comfortable and confident so you can enjoy your retirement. That's really important. The psychology of finance has to be taken into account when you go into retirement. I can sit here and tell you what you should do, but if you can't sleep at night, it's not what you should do. That is so important to understand. No chart is going to tell me what's right for you. We have to make sure that it's right for you so you can sleep and enjoy your retirement. Just because the chart says it's right doesn't mean it's right for you. All right? So let's make sure that we're paying attention to these things in our portfolio. Take a look at your situation. If you have questions, if you need help, if you want to go through and analyze what's going on in your portfolio, give us a call anytime. We're happy to do it. I love looking at this stuff. It's a great puzzle for me. And this whole planning process should hopefully let you take that step back and look at your situation objectively as opposed to be caught in the weeds looking and living in that day-to-day. All right? So give us a call if we can help out in any way. Obviously, I'm passionate about this stuff. Shoot us an email. If you love the video, click like on it, share it with friends. And if you haven't subscribed to our channel, please do. We're still rising. And my first benchmark is hitting 500 subscribers. That's my first goal. Then we're going to go after 1,000. Great to see you. See you next week. Thanks again.